Good evening. Welcome to all the participants. It gives me great pleasure to host today's webinar. And the topic for discussion today is businesses generate wealth, not the market. In today's context, it is very relevant and contemporary topic to dwell upon as market has claimed a new high even today. We have Mr. Anand Shah, who is head of PMS and AIF at ICICI Prudential AMC, who has about 20 years of rich experience, and he has worked in very senior positions in BNB Paribas and NJ Asset Management prior to joining ICICI. I welcome Mr. Anand to present the strategies to the participant.
Thank you, Mr. Sivaram, and a very, very warm, very good evening, very, very warm welcome to all the participants. Hope in these tough times, everybody is trying to be safe. I think it's very important. This phase will also pass and things will only get better from here is my conviction. But nevertheless, keep safe. I think that's the only option at this point of time. Today, what, as Mr. Sivaram already spoke about, that businesses generate wealth and not markets, I think is more relevant today than ever before. But that's a fundamental thesis which we have very strong belief in, and let me speak about it. But outside that, I understand a lot of you would have questions on markets, questions on valuations, and I do understand people would be concerned on all these things. So what we'll do, we'll definitely leave at least another 20-30 minutes from a Q&A perspective just to answer all the concerns you might have on the markets. But before that, in next 30 minutes, 35 minutes, what I intend to do is to give you an insight into how at ICICI Prudential Asset Management, within the alternate investments, what are we doing and how are we geared, or how are we prepared to navigate this market and create wealth for our investors. So over next 35 odd minutes, what I intend to do is give you some understanding of where the thought process comes from, what is behind our thought process, what is the investment philosophy, what is the team that supports this PMS funds management at ICICI Prudential. Then obviously, I'm not covering entire market, but give you an understanding further on where are the market opportunities to sustainably create wealth. And last, just the culmination of all the philosophy process and the market opportunities, I'll just share that with you quickly on the portfolios that we run. So without much ado, let me start. This is very simple but very, very powerful. I know things are not as simple as they look, but to start with, a price of a company or a price of a stock is a function of the underlying earnings of the company and the multiples we give to that. And very honestly, any change in the price is a function of change in the earnings and change in the P multiple that we give to that earnings. And if you will see, as you increase your investment horizon, as you go forward, most important thing is actually the delta in the earnings. And the delta in the PE matters in the short term, to some extent in the medium term also. But the moment you increase your horizon of investment, I think what we really need to get right is delta EPS. And this is where we are completely focused on. Not saying that we are not aware or not concerned about delta PE, we are aware of it. Should not destroy wealth, and if it can create more wealth, if you can buy at a reasonable valuations or a cheaper valuations, we're more than happy to buy. But I think a large part of our focus remains on identifying companies which can grow earnings for long periods of time. So the delta EPS for long periods of time is, I think, we are completely focused on. And as I rightly said, over long term, I think that is the biggest driver of the stock price, and that's what you should also be focused on. I'm giving you just 4 random examples across different sectors where you can see that a large part of the price growth is a function of PAT growth. And if you see, even the PE expansion is also a function of earnings growth rate. So in a way, earnings growth rate is not only contributing to the price, but is also contributing to some extent in the change in the PE multiples. So I think we are right track where we are saying we are largely focused on identifying businesses which have grown. Now, within that, if you see, there are two very important elements in identifying companies which can grow. One is the ROE and other is revenue growth. Just giving you some background, we will come to and we'll discuss investment philosophy. A lot of these we'll cover, but basically, we need sustainable earnings growth rate for which companies need to have an entry barrier.
So, as I was saying, it is companies that create wealth and not markets, or businesses that generate wealth. I think that's a key focus. If you see the next slide, uh, the way we construct portfolio is first we identifying all the high conviction ideas that we have. We have a long research team, large research team, which is supporting us in identifying one of the finest companies. The other important element is longevity of ideas. So very clearly, we are looking for businesses which not only creates wealth in the short term, but also can create wealth in a very long term also. So I think high conviction ideas with strong earnings growth rate, longevity of idea is very important. And the last but not the least, I think when we are saying for the discerning customers like you, we are creating uh, a unique portfolio. It is nothing but wherever we have high conviction, we actually build a far higher weightages. So if we have a certain sector, which you will see in our portfolio, like metals, we have a large overweight, we don't shy away from taking large weightages. So the whole idea of creating superior performance for our investors, I think important is wherever we have high conviction, we have a reasonable overweights there. Be it individual stocks, be it individual sectors, or recently, if you see, our portfolios have extremely high value bias also. So we are very confident that any economic recovery, the value style of investing has actually outperformed other styles of investing. And to that extent, if you see in our portfolios, there is a far higher tilt of values. So one of the three or all three of them will get reflected in our portfolio. So if we like a certain sector or certain company, I'll give you another example that is in our portfolio is Bharti Airtel. Now, it is not so much of a sector call, but also of a company call, which is going to be a survivor in this competition and will end up, uh, be the key beneficiary when the sector consolidates. And so I think this is very important when it comes to constructing the portfolio. So once we identify high conviction companies with longevity of businesses, then we load it up in terms of weightages if we like the valuations extremely well. How do we identify these high conviction ideas? I think I spoke about portfolio construction, but before that, how do we identify these high conviction ideas? As you can see on your screen, we have this in-house BM with a model of identifying companies which can grow earnings at a superior and sustainable rate, which is nothing but business management and valuation filter. First filter is business, because if a company doesn't go through a business filter, then we don't care about what is the quality of management and what is the valuation of the company. So a high focus on business. Once we like business, we go to management. If we don't like management, it doesn't matter what price it is trading at. We are not in the business of buying cheap companies. We are in the business of buying good businesses run by a reasonably good management, competent management. So that's the second filter. Once we like business and management is when we move to valuations, where we are not claiming that we'll buy one of the cheapest stocks in the market, but we do claim that we'll buy good businesses and good management at a valuations which will not destroy. So if you recall my first slide, which is delta PE, we need not lose wealth on delta PE. And to that extent, I think we are very focused on making sure that we don't overpay for a business, that we end up not making money even when business does well, right? So I think to identify good business and pay a price so that when the business does well eventually, you also participate along with as a minority shareholder. Let me focus 5 minutes on business. I think this is where I would spend most time, because management valuation is fairly easy. But when it comes to business, we are looking at distinctly three things. We look at 100 things. Among those 100 things, three things are very important for us, distinctly important for us. One is growth. We continuously evaluate and see what sectors can do very well in next 5 years, 10 years, 15 years, which segment of the market where the middle class will incrementally spend, where we will find penetration going up, where will we find per capita consumption going up. So we are continuously in search of industries which can go faster than GDP structure. The word is structurally, because 1 year, 2 year, nahi, but structurally, is there a product or a service which is under penetrated and can grow very fast? To give you an example, is like quick service restaurants or restaurant business. I think it's a long way to go in terms of how many times people will eat out or call the food in, and so on and so forth, or multiplex, or many more such, where the penetration is very low. We are going to see more people committing and consuming more of those goods and services. So once we identify good industry, then we say which are the companies within that industry which will grow faster. So very clearly, growth is a very important parameter for us. Industry is growing faster than GDP, companies growing faster than industry. The second important plot, or a second important element in our stock identifying, is moat, what we call sustainable competitive advantage. Basically, any business which is good will attract competition. Do we have a business? And every company that we invest in our portfolio has to have a moat, has to have a sustainable competitive advantage, so that there is an entry barrier. Not many people can come and spoil your profitability. That is very important. And that also reflects in a high ROEs that the companies have. If you have a large entry barrier, you can sustainably make higher ROE. So it's going together, which is a high moat businesses, high entry barrier businesses can continue to make high return on equity sustainably. So that's another. This can be a brand like Dove or Nestle or others, which are very strong brand franchises. Even in financial services, all these brands do very well. Second is industry structure like cement and others, which is fairly consolidated, or technology, or a cost advantage, or a distribution strength. Companies like Hindustan Zinc and Tata Steel have access to one of the cheapest raw materials in the world. We can go on and on. Those are the examples I'm talking about. And last but not the least, for wealth creation, very important is the industry structure. Where are we seeing the consolidation in industry? Other the new players entering that business, you would not want to be in that industry significantly. But if you are people exiting that industry, to give you an example, today telecom is that place where actually we are seeing lesser and lesser number of players, given that there's a significant consolidation in this industry. I think that augurs very well for the wealth creation in times to come. I think management, we are looking for competency both in their ability to conduct the business, but also in corporate governance. So management leadership we are looking at. And last but not the least, we are very, very focused on the cash flow generated by the business. I think that's also very important as we go further. Moving on, quickly, we have already a team of 3 fund managers, including myself. But I think very importantly, we have a very large team of research analysts at ICICI Prudential AMC, where we have one of the largest equity fund houses in the country. That all research team is available for us to do a lot of analysis on individual companies. We have more than 400 companies, researched by our own research team. Apart from that, we also have support from sell-side research, which keeps on providing ideas. Just moving on quickly, I said I will be fast. I think on the markets, there's another thing which people are interested, what's happening on the market in the midst of COVID. I think very clearly we are looking at 3 segments, or we are dividing markets into 3 phases. One is the companies, the sectors dependent on the global recovery. I think there we are already seeing a very, very strong recovery in sales, profits, cash flows, in the sectors like metals, chemicals, textiles, IT, pharmaceuticals. They are all doing extremely well, especially in the metals and the IT services. We all know are doing very well. Then you have a set of companies which are dependent on the domestic recovery, and there they were fairly resilient. They were not really struggling, but nevertheless, we didn't have growth in these segments like banking, cement, telecom, domestic pharma, and all that. FMCG, consumer non-durables, consumer durables, all those elements were sort of struggling because either there's a partial lockdown or full lockdown. I think that's also recovering well. Our take is that the Delta wave or the Delta variant of the virus, which is creating today havoc in other parts of the world, is already in a way passed through in India. And we have seen that virus already hitting us before others. So for our internal assessment is that our phase or the wave 3 will not be that deadly as it was the wave 2 when there was genuinely a Delta variant. So that's domestic recovery. The last one, which is parts of the economy which are suffering the most because of a lockdown, I think they will take a little longer to recover. But we are today, as we speak, significantly invested both in the global recovery and domestic recovery as we speak. So that's one way of looking at market. But I think when I spoke about superior and sustainable earnings growth rate, I think the other part of the element is this. This is why I'm saying that, we can keep on discussing macro. We can keep on looking at, whether the GDP is growing at 5% or 6% or 7%, interest rates are going up or down. I think these are the opportunities where wealth has been created through last 10, 20, 30 years also, without worrying too much about macro. And this is something which really interests us. This is where we keep on looking for companies where we have opportunities to create wealth over a long period of time. One is emerging sectors. What are the sectors itself which is growing very fast? I spoke about, restaurants business ho gaya, ya multiplexes ho gaya, even life insurance business. Everywhere we are seeing the penetration is low and opportunity is huge. Secular growth is possible here, and we continuously invest in these segments of the market. So this is very attractive for us. We keep on looking for leaders in this space to invest in our business. The second element, post-demand, post-GST, and even the COVID has helped to some extent, where we have seen the organized player having upper hand over an unorganized player in that same sector. And we have seen significant market share gains in some sorts of sectors like paints and others where we have benefited. So this is another way where you can create a sustainable, faster earnings growth rate. And last but not the least, this is where again a lot of our winners are there in our portfolio, where efficient players gain market share from inefficient players. And that's again happening very fast. The large players are gaining a market share from smaller players. The efficient players are gaining market share from inefficient players. If you see in last so many years, very clearly you can see how in banks, in cement, in steel, everywhere you get it, telecom more recently, continuous gain by the top 3, top 4, top 5 guys as we go ahead and we see that. So clearly, these are the various bottom-up opportunities where again we can find multi-baggers or people who can grow earnings at a faster and superior rate. So net, my point is, I think there are enough and more opportunities in the market. Government has reduced corporate tax rates significantly in September of 2019. Interest rates have come off significantly. Both put together have added almost 1.5 lakh crores benefits to the corporate sector in India. Government is investing significantly for Make in India, for investments in manufacturing in this country. That's working very good. GST will come back and help us, the organized sector. And last but not the least, as I spoke, global recovery and domestic recovery is, our take is very much there. So net, whichever way I look at it, I find a lot of opportunities in market where we have very good earnings growth rate. I think that's very important because notwithstanding market is at an all-time high and PE multiples in some pockets of the market is very high. Our take is that especially in manufacturing, private sector capex, infrastructure, select consumption stories, select export stories, they're all looking up significantly. So time for bottom-up stock picking rather than really worrying about only that. That brings me to the interesting element which you all would be interested in, that whatever theory I spoke about DMV, identifying businesses which can grow earnings. What is it today? Where do you see those opportunities today in the marketplace? And why do they fit into many of these global recovery, domestic recovery, consolidation themes as we speak about? Just before I go to the portfolios, I think as I spoke before that we are very, very clear that we want meaningful and sustainable earnings growth rate. This is a COVID year, and you can see what sort of earnings growth rate we have seen. We also giving benefit of doubt and saying let's remove companies which have really grown very rapidly. Somebody in metals and others have grown 300%, 200%. So we removed all the companies with greater than 100% or those who were actually turned from profit to loss because they had a lockdown. Still, our portfolios have a very, very superior earnings growth rate of 24% in the COVID year. And obviously, actual earnings growth rate was much higher. I think the other element which I spoke about, that valuations is tricky in a very small pockets of the market, especially in B2C business. That doesn't mean valuations are very expensive across the market. So you can see that our contra portfolio actually with a 120% earnings growth rate, within that if you normalize it, it's 24% earnings growth rate. Still, we have only 17 P multiple and 2 times price to book. Same applies for pipe, where the earnings growth rate is yet to pick up. Q1 is looking very good, but again, the valuations are very, very attractive. So here we have more value tilt. Flexi is more growth oriented. So the valuations are a little higher, but there we will see much higher and longer sustainable earnings growth rate. So all the three strategies are different, and I'll cover them in a while. But I think the common theme is superior and sustainable earnings growth rate in all three of them. Talking of contra, I think again we are looking for a high mode businesses, high entry barrier businesses, going through a little difficult phase, like telecom was going through that phase in 2016-17, or steel was going through that phase in last 5-7 years as China continued to gain significant steel capacities, or corporate banks were going through that phase in last 5 years since asset quality review in 2015. I think that's changing. So if you see our portfolio today has a large overweight on steel, and here is where again I will spend a couple of minutes to explain to you what is happening. 56% of the world's steel is produced in China, and China as a country is increasing its per capita income significantly. People are richer and they want lower pollution in their own country. So China is significantly investing in lowering pollution in their own country. On top of it, they are reducing exports benefits which are given to them. So basically, they want to produce steel only for their own consumption, which was not the case 2 years back, 3 years back, 4 years back when they were a large exporter of steel. I think this is a game changer for Indian steel industry, which is competitive. It has an access to low raw material. It's a huge moat. We are far more competitive than China. And now we also have an export market opening up for Indian steel segment. Even though the domestic growth is slow, in this quarter also steel companies could export a lot of steel and continue to make money. So I think Indian steel sector is entering a phase where you have a strong cash flows, strong deleveraging, and also growth coming through. The other one is banking, which is a large overweight for our contra portfolio, where, as I said, a lot of these banks have a very high NPA because of the historic lending. But if you see today, their slippages are going down significantly, even in the COVID year, because a large part of their book is now actually retail housing. So SBI, ICICI, Axis, these are the stocks we have in our portfolios. Again, none of these are recommendations. Please don't take it that way. But I'm just saying that these are the banks which are going through a 5 year of consolidation in terms of providing for the past NPS, but the new book is actually very good, mostly in retail. And last sector that we have a large overweight is in telecom, where it's a classic case of consolidation. Companies are coming off. We are left with 3 players in the market with 4G capability. And to that extent, from 13 players, strong market is down to 3 players. Consolidation is one of the biggest drivers. Obviously, India is a young population. We have a demand for data. Penetration also can continue to increase for a while. So I think this is another sector that we like. So if you see our portfolio, we generally don't invest more than 7% in any of the company at a time of investment. The top 2 holdings, which have become 10%, have become 10% on the back of the growth on itself. But otherwise, rest of the companies, you can see, are beneficiaries of global recovery, like Vardhman ho gaya, Tata Steel ho gaya. These are all beneficiaries of global recovery, whereas the banks are beneficiaries of domestic recovery. Bharti Airtel will also benefit from the domestic recovery and the consolidation of the industry. IT services like HCL and others are beneficiaries of a global recovery. We have 25% in banks, 20% in ferrous metals, software, telecom. In that, as I said, we have a reasonable valuations on these sectors at this point of time. We have significant large cap exposure, but also decent mid cap and small cap exposure in the portfolio. And you can see how the performance has stacked up in last 6 months, where we have almost 33% portfolio performance versus 18% for the benchmark. I think this is what we are saying, that for a discerning investors like you, we want to give you a portfolio of only 25-30 stocks, but each one of them is very well researched, very high conviction, and growing earnings very rapidly. And this is the divergence which you can see now that's coming through as far as portfolio is concerned. Similarly, in pipe, we are looking for companies which are small, but they will become mid-size or the big size. So I think very clearly, again, very importantly, we are not looking for small gains. We are looking for companies which can transform themselves from being small-sized company to mid-sized companies. The mid-sized companies can transform into large-sized. So I think that's the fundamental thesis. We are looking for sustainable growth, superior growth. And that, again, generally the leaders in the emerging sector or the efficient players in the large sector are the companies which can keep on gaining market share. Again, a good set of mix of small cap and mid cap that we have. Companies have a very, very strong earnings growth rate, strong moat. I think both in Contra and Pipe, there is no compromise on the sustainable competitive advantage for these companies. These companies like Godavari Sarda have a huge advantage of having a captive iron ore, which in the tough times like this, when a lot of people are not making money, they continue to make good return on investments at this point of time. This is a list of the companies that we have. These are the exposures we have: ferrous metals, finance, transportation. Transportation, we have an exposure to companies which are beneficiaries of dedicated freight corridor, which is also a game changer as far as infrastructure is concerned. Again, the portfolio performance is extremely good with a 50% large cap, 50% mid cap. This portfolio has delivered as good as the small cap 100%. So that's another strategy for you. This is strategy for somebody who are looking to invest for longer periods of time. I think small cap, mid cap will be inherently more volatile than the Contra strategy. So somebody who has a high risk appetite and a long investment horizon can look to have some exposure to the pipe strategy. Otherwise, Contra strategy is very, very reasonable strategy. So with that, I want to stop here. As I promised, I will stop in 30-35 minutes so that we have enough time for Q&A. Let me wrap up, do a little bit of a summary for all of you. I'm again repeating, money making is not difficult. It needs patience. It needs conviction. Once you invest, you need to give 3 years, 5 years. But as I explained to you, it's not rocket science. I think as your portfolio manager, we continuously look for companies which can grow earnings for a long period of time, and then the volatility significantly reduces as we increase the time horizon. So we have an in-house BMV framework to identify companies which can grow earnings for a long periods of time. Then we go ahead and, having identified those companies, build a concentrated portfolio of these high conviction ideas. And the big element is the longevity of these investment ideas. That also improves, lowers the taxation and improves the experience, overall experience for the investors, because typically a stock we buy, our intention is not to sell ever, but generally the stock stays in the portfolio for multiple years as we speak. So with that, thank you very much for patient hearing. I would be happy to take any questions around the markets, around our strategy, our philosophy, our portfolios, and would be happy to take any feedback also from you. So with that, I stop. And Mr. Sivaram, thank you very much for patience. And I will, be happy to take any questions if they are there.
It's wonderful. Participants, and in fact, you can post your questions, if any, for Mr. Anand in the Q&A or chat box, so that we can post those questions to Mr. Anand and we will get the answer. Meanwhile, Mr. Anand, we have already had some questions after seeing your presentation. I'll go one by one. After that, if time permits, we will go to the Q&A box where other questions are posted. Okay. And the first question is on, in the current market condition, is it better to be in the flexi cap as mid cap and small cap have performed outstandingly well in the last 1 year? What is your take?
No, I think in any economic recovery, to be very honest, small caps and mid caps would also have a far higher earnings growth rate than large caps. So to be very honest, I don't have a preference for one versus other, but then investor has to look at his own portfolio and see whether he has enough exposure to the small and mid caps. Typically, a investor portfolio should have at least 20% of mid and small cap if he has 5 years plus investment horizon. And to that extent, they can have either a flexi cap, which is itself will give you 20-30% of exposure. But if you want an enhanced exposure to mid cap and small cap, then you should use PIPE as a portfolio. But I agree with you, flexi cap is very clearly giving you at least 30% exposure to the mid and small.
Okay. The question number 2 is the contra investing. People generally think it is low PE investments. And can you explain what is contra investing and how different it is from low PE investments, what generally the kind of investors think it is?
So I'll give you a couple of examples. I hope it helps. So contra investing need not be low PE investing. To be very honest, when actually we bought steel, it might have been loss making. To that extent, the PE would have been infinite. So it need not be low PE, but nevertheless, what we are looking for is strong businesses going through a short-term pain or a short-term or a medium-term. In sector like steel, it's been for 5 to 6 years that you had a overcapacity globally, low demand growth rate, and to that extent, there was an extended pain to the extent that in country like India, Bhushan, SR, they all sort of went bankrupt. So that was the right time when actually industry was consolidating. All these weak players were being bought over by the strong players like Tata Steel and Nippon and others, ArcelorMittal. So typically that is one. The other example which I'll give you is corporate banks becoming retail banks. So a lot of these banks which had a heavy portfolio on corporate had an incessant provisioning. So your operating profit was high, but because of the provisioning, your reported profit was very low. So under the surface, the things were improving, but when you're looking at P&L, you're not able to see the improvement for 2 years, 3 years, 4 years. So those are the businesses where we are seeing a turnaround, seeing a transformation. I'll give you third example is today Bharti. It's not a low PE investing, but it's a contrary investing where industry is not making money, cash flows are difficult to come by, return on equity is very low in this industry because we all get unlimited voice and unlimited data for 140 rupees. And I think this is not sustainable. Our mobile bills will go up at some point of time because industry is not making money and this industry is only now 3 players left. So our belief is that the pricing will improve and that would benefit and then it will become value. So at the time of investing, it might not be low PE, but the idea is you're getting it such a valuation that when the cycle turns, it will continue to go up and still remain low PE.
Can we move on to the next question, Mr. Anand?
Yes.
Okay, Mr. Govind was asked in the chat box, steel, both ferrous and non-ferrous have run up very steeply. Do you think there is more upside in the sector as it attracted a lot of investor attention of late? What is your outlook for the steel sector, say for next 5 years? As you mentioned, China is still a joker in the pack.
Yeah, I think very clearly, this is a sector which is dynamic. I'm saying this is a sector which suffered from overcapacity in China and the exports from China. Our belief is Indian steel companies, particularly the companies with a captive iron ore, are very well placed in such times where you can have a fear of a lower steel price in times to come. My only point here is that maybe the profit growth will not be as exciting as it was in 2021 and it will be in 2022, but a very strong cash flows and even the reasonable valuations which we have to keep an eye on. I think this sector is still looking attractive for us. We keep on watching this sector very closely. We keep on looking at international iron ore prices, international coking coal prices, international steel prices. So it's a dynamic sector, and for that matter, every sector is dynamic. So I can't give you any view, forever. But as we see today, this sector continues to look good for at least foreseeable future. But you would know these sectors, especially the metals, are notorious in the past. The sectors tend to be volatile. To that extent, I would refrain anybody to really, take this as a stock call or as an advice. I'm just sharing my views as I see today. But as I am saying, this is a sector which is not easy and one needs to watch very carefully. We have elements and instruments to track them on a regular basis, and that's how we benefit from large research team who tracks global markets in this metal, what's happening in Brazil and Australia on iron ore. So it's a complicated stuff, and to that extent, please don't take any of these as a stock advice.
No, and in fact, it is better to leave these calls to professionals like you, and in fact, with a very large research team you have, and in fact, it is a very clear advice from you not to nibble into this unless you have some professional advice. Thank you for that. And many people are asking, is it the right time? Market valuation is high. These questions keep coming for the last 1 year, but market keeps hitting the new highs. And in fact, this is a vexed question which keeps coming every time to all the webinars we handle. And what is your outlook? And in fact, is it the right time to invest? These questions are the first questions which are coming from the investors. But market doesn't listen to anyone. It keeps hitting the new highs as it is today. What is your outlook, Anand, on is it the right time?
I think first and foremost, let me tell you, my humble submission to all of you is investing in equity might be risky, but not investing in equity is definitely risky. Why I'm saying that inflation is a part and parcel of our life. We can't wish away inflation, and to that extent, things are only going to get expensive every year. And in the next 15, 20 years, things will be very, very expensive. Now, whatever money we save today, if it's not invested gainfully, if it's not invested in an instrument which does better than the inflation, I think our savings keeps on getting devalued to the extent of inflation. So I am again repeating that we need to make equity our friend. The challenge with equity is volatility. So again, I'm repeating, equity investing can be risky, but not investing is definitely risky. Means from a 5-year, 10-year, 15-year perspective, I don't think we have an option but to invest in equity. But the challenge is volatility, because we invest today, stock market goes up 20%, we feel good and we leverage, we get excited, we become greedy. Similarly, we invest today and the stock market goes down 20%, we become fearful. So I think the key in equity investing is managing this greed and fear. Otherwise, rich valuations is not that much of an issue. Uh, People who have invested at peaks of 2000 and peaks of 2007 also have made money in the markets today. So I think market has a tendency to go new highs because the earnings underlying EPS keeps on going up because underlying businesses are doing well, economy is doing well. So I think I would not be afraid of peak valuations, but yes, there is always elements which you can use, like STP is what we offer, where you do systematic investment. So you don't put lump sum money into the market. You are wary of the valuations. You are wary that things are expensive today. You break it down for like 12 months. You do it every month, or you can do your own element. You might say a target, if the market falls so much or market goes up so much, every 3 months I want to invest. So you can learn to benefit from this volatility rather than being afraid of the short-term volatility of market. Market over a 5-year, 10-year, 15-year has a direction up, but in between it has got a lot of volatility. I think you need to make the friends with this volatility rather than making it your enemy. Uh, you need to be greedy when others are fearful, and you need to be fearful when others are greedy. As I see in the market, everybody is still cautious on the market, which is not a bad thing. I think to be cautious is very important so that you don't uh, over invest or you don't leverage and invest in the equity markets.
So your suggestion is to go for an STP route now. That would what you would suggest now.
Yeah, I think that is ideal solution for any such markets where valuations is looking high or markets are going up significantly. So you can always de-risk it through STP. It might not be the ideal, but nevertheless, it's still you are started investing in equity through STP.
It mitigates some risk at least of investing at single go. Thank you very much, Mr. Anand. Can we go to the next question?
Yes.
It is on generally on the market. Small cap has seen some corrections last week, and the volatility is going to increase in coming quarters, and the space is what someone wants to know. What is your, this is regarding your pipe portfolio, and what is the volatility going to increase in the coming time is what you would like to know.
I think, again, I keep on telling people differentiate between risk and volatility. Volatility, one need not afraid. Volatility is where the stock prices go down and then they go up, back up again. The risk is what one should be cognizant of. The risk is where you invest into the stock, it goes down and never comes back up. I think even in these markets, I have interacted with few people who have lost 90%, 80% in some stocks. So I think one needs to be cognizant of the risk, as Mr. Sivaram also said. Be with professional advice because you can mitigate the risk part. You cannot wish away the volatility of equity market. It's by nature will be volatile, and to that extent, I'm repeating again what I said. Make it a friend through an STP. STP is available in PMS also. STP is available in mutual fund also. Make STP your friend, volatility your friend. Invariably, whenever markets are hot, there will be people who will be speculating, There will be people who will be leveraging, because of which all this volatility gets created. I think you can negate it and benefit from that through an STP.
Okay, and in spite of industry PE of 47 in the small cap space, your pipe portfolio has got a PE of 13, which is very striking. And in fact, still you have returned more than the market, and returns were simply outstanding. Can you throw some light? What is your approach in this pipe portfolio in the for the next few years?
I think a very, very relevant question, because people are generally afraid of high valuations. And I keep on telling people that high valuations is a problem in very small segment of the market. There is B2C businesses where we might have very high valuations, some consumer companies. But otherwise, the place, and especially where we are very, very constructive and look at strong earnings growth rate, which is manufacturing, private sector capex, industrials. These are the few companies where even the valuations is not an issue and earnings growth is very strong. So you're right, both contra and pipe benefits from a very, very strong earnings growth rate in the sector, which is not very expensive. So you have a good combination of strong earnings growth rate and a low valuations in these two portfolios.
The next question is opposite to this. In your flexi cap, almost you rhyme the price to book, and the price to book is equal to the market, and still you have created alpha. And how do you see this portfolio in the next few years when it comes to the flexi cap portfolio?
I think flexi cap is a little high on quality. It is investing in blue chips more than contra, and to that extent, the P multiple is a little higher. But again, I'm repeating that the key to creating wealth in the market is to focus on earnings growth rate, on which flexi cap also continues to be very strong. So I'm reasonably fine that even you can make money through investing in contrarian strategy, but you can make money, equally good money, by investing into the flexi cap strategy also.
Some customer wants to know, and in fact, can he divide the 50 lakhs into different strategies?
Indeed. So it is the 50 lakh number is for across the strategies. So you can divide into 1 or 2 or 3 strategies.
That is a very good input. And market experts like you, everyone are bullish, and the provisions in the banking is enough to cover all the bad debts and all. But still, COVID is not behind us. And is there any fear of new provisions hitting the banks? And do you think the banks in your portfolio has got enough provision to tackle some unforeseen in the times to come?
I think one needs to realize where the NPAs are coming from. And to be very honest, last 5 years we had NPAs largely from the corporate book. But in this second wave, if you see, the businesses are not badly impacted. It is the household which was more impacted. So if you see in the first wave, when businesses were impacted significantly, but human lives were saved because you had a very, very strict lockdown, which actually hurt the economy significantly. If you see in the second wave, we have not gone for a very strict lockdown. We have not gone for closing down the industrial companies. And to that extent, I think market also didn't correct significantly in the midst of the second wave. But even the industrial profitability is looking up, and even the bank's NPAs in the corporate sector was not very high. It is only in the retail segment that we have seen higher NPAs. My take is in the third wave, the impact on the industrials and the companies will be further lower. And even on the human lives should be far lower as we are vaccinating rapidly. We have a high seroprevalence, which means more and more people are already immunized or have immunity because of the past infection. So to that extent, my take is that we might not see a worse wave than what we have seen in the second.
And
things will look up. Things will look up for the banking sector.
That is good. And in fact, that is a great feedback. And what is your, are you going to participate in upcoming IPOs? IPOs have made lots of money, but limited data will be available with all the research houses. What is your take, and how do you differentiate IPOs where you can log in, or it is worth investing? What is your strategy in this PMS when it comes to IPOs?
Look, to be very honest, we don't like the valuations at which these IPOs are coming up. We find the valuations are not really attractive for a company which doesn't have a track record. In many of these companies where we have a comparable companies in the listed space which have a 10-year, 15-year history, track record, and size also, they are coming cheaper. So we have refrained from investing in most of these IPOs. And again, these are listing gains which we are talking about, but these are on the back of very little allotments as we speak. So we have sort of refrained from investing in IPOs in this very, very expensive valuations.
Very insane it is. I would totally agree. That the valuations are very crazy. It is nice to hear that you don't touch that area at all. And that's it. And in fact, some more questions have come. We are running out of time. And those questions we will definitely send you. I don't think you will mind answering them, so that we can get back to the investors with your answer, because there are few questions which we would be able to answer, and what needs your attention, definitely we will send it across. We will get your answer and we will get back to them. Is there any closing remark you want to give, Mr. Anand, on generally what you have covered, and a gist of it, or what you wanted to tell the investors in general?
No, I think first and foremost, thanks for every participant who has joined us, and thank you, PMS Bazaar as well. I think a very important point is that India is coming out of 5 years of pain. I think if you see from asset quality review in September 2015, June 2015, till Demon in November 2016, then GST through the 2017, and then you had an NBFC crisis in 2018. Then you had a slowdown in 2019, if you remember, consumer slowdown and the Yes Bank debacle. And then 2020, we had a COVID. So I think corporate sector and GDP in general has taken a lot of pain. And to that extent, my take is that India has done many reforms which are very, very good. We are focusing on manufacturing, focus through PLI, we are getting investments. China Plus One is doing very well. My take is that we are in for a good number of years where the economy can continue to remain good until we have new accidents. But my take is, with so many accidents that we had, I think notwithstanding that there will be corrections in market, and in every bull market also we will have corrections of 10, 20, 30%. I think I am personally very optimistic and convinced of the good long-term prospects of Indian equity markets, Indian economy. And to that extent, I will just repeat that you need to do risk management. You need to make sure that you invest for the long term. If you have, less conviction, do it through STP. But I think overall we are quite sanguine about economy. On top of it, as you also said, Mr. Sivaram, that I think taking a professional advice is very, very important. Markets have become more and more complicated over time. It is not a straightforward market anymore. We need to analyze a lot of stuff, and we have large research team. We have significant risk management team also in our place. So ICICI Prudential as a platform has sound philosophy, strong processes, research team, deep research team, and significant risk management capabilities to give you that sort of service as you would need. So that is what I would like to summarize for today. Thanks again very much for the opportunity, as well as all the participants for joining us.
Thank you, Anand. In fact, it was so enriching. And in fact, you have very humbly answered all the questions. I want to thank all the participants also who have come in to participate in this program. God bless you. Thank you very much.